suppose at this point, let's just kick it off. We do have quite a bit to cover as we get into the final few months of 2022. It has been a challenging year for global financial markets. Inflation, of course, sharply higher interest rates, geopolitical concerns that have still not resolved themselves, and more. They've been jostling not just the global economy, but jostling investor portfolios as well. As we talk through these topics, we're going to share our views on what happened and why, and most importantly, what we're doing about it in your portfolios today. My name is Jerry Guger, Head of Content Strategy at Manning Napier, focused on bringing you the unique views and perspectives of our firm. And I am excited to be joined here today by Margaret Jeffries. Margaret is a wealth management consultant from our advisory services group, focused primarily on supporting our wealth management financial consultant teams through financial planning advice, guidance, and strategies as we help our clients plan for and achieve their financial goals. Margaret, welcome.
Thanks for having me.
And I'm also joined here today by Jay Wells. Jay is a member of both the U.S. and non-U.S. core portfolio management teams. For those unaware, the core teams are responsible for managing our traditional investment research processes for our 100% all equity portfolios, both domestically and abroad. In addition, Jay is also the managing director of our technology sector group, responsible for identifying, analyzing, and investing in the TMT, or should I say the telecom, media, and information technology space within our traditional bottom-up led investment strategies. Jay, welcome.
Thanks, Jerry. Happy to be here.
Fabulous. And our agenda today is as follows. We're first going to start with a discussion of the state of the economy and its impending slowdown, then provide some additional color on inflation specifically and what we're watching for, and then wrap up with our view on global financial markets specifically. And we're calling this section Economic Rain. After the rain, we'll get to what we're calling planting the seeds. And this is our way of saying that only after rain can you start to have growth, and only after a certain amount of challenges can portfolios really start to grow. And we believe we're in the process of that right now, and we're preparing portfolios for that growth opportunity that we think is likely to present itself on the other side. After those two sections, we're then going to dive straight into live Q&A, as well as answer a number of pre-submitted questions we received ahead of time. So as always, thank you for those. And as a reminder, please feel free to submit any questions you have at any point during today's event, not just towards the end of the proceedings. All right, and so with that, I'd like to take a minute to introduce a theme of today's event. And as always, we have a quote. And this is one of our longer quotes that we've done, and I'll take a second to read it. You get recessions, you get stock market declines. Understanding that they're going to happen is what enables you to do well in markets. This is not exactly Peter Lynch's quote. We've adapted it in sort of a Manning Napier way of thinking, but this quote relates to so many other messages that we've been sharing of late. And we're currently going through a client event series with so many of you right now. And one, it's great hearing and seeing all of you in person again. And a common theme has struck us during these events, and proudly we should add, is how many of you already know these timeless investing truths, or at least similar ones to this. It speaks to all of you as clients, your own wisdom, temperament, and calm. But for us, it also speaks to the importance of having lessons learned, practice disciplines, and patience. So I think certainly that should be noted. And I'll also say, for good measure, Jay, I know you've done one of these calls before towards the summer months last year. At that time, the quote we had used, and it wasn't really a quote, but we put it up on the screen anyway. We love it when a plan comes together. That was what we had shared as the theme for that event. Margaret, I see you smiling and laughing. That's exactly it. It's this importance of planning with this wisdom and temperament, understanding that the economy, recessions will happen, understanding that with markets, sell-offs will happen, understanding that while history doesn't repeat, it does rhyme, and that it's how you react to these challenges that is the most important decision of them all. That's what proper planning empowers you to do, to lay out, document, internalize, understand your goals and objectives and what you're doing to achieve those. That's what helps you get from A to B, even knowing that there's going to be challenges along the way. So with that, I know that was the 10,000-foot view. Jay, I want to take a second to turn it over to you to give us a little more color on specifically what we're seeing and why. Jay?
Sure. Thanks, Jerry. So I want to start off talking about the economy. And so, certainly exiting COVID, there was a surge of demand as the world returned to normal. That was amplified by unprecedented monetary and fiscal stimulus. So monetary stimulus, that would be the Federal Reserve and really central banks around the world holding interest rates, near or at zero. We also saw central banks purchase financial assets. And then fiscal stimulus, an example of that would be, various forms of government spending, whether it be tax cuts, spending on infrastructure, sending consumers stimulus checks would be another example. We're now late in the economic cycle with slowing economic growth and a growing risk of recession. So in retrospect, I think it was certainly fair to say that post-COVID interest rates were kept at zero for far too long. And there was also a great deal, really record amounts of government spending into an economy that was really already sharply rebounding as people got back out and were living their lives again post-COVID. So the surge in demand combined with supply chain and labor market constraints led to a generational increase in inflation, which is exactly what you see on the chart here. And it's a case that there's been too much money chasing too few goods. So the end result is, the Federal Reserve, as the slide here implies, has been playing catch up. They're aggressively raising interest rates to get inflation under control. And you can see here, it's the chart of the yield curve, how much rates have already increased this year. So we had another set of interest rate hikes just the other day. That was the fourth set of 75 basis point hikes. So if on the left-hand side of the x-axis, moving on the left side on years of maturity, short-term interest rates have went from near zero to around 3% plus today. As you move out on the x-axis to the right, years of maturity, when you get out to bonds that are dated 10 or 30 years, you've actually gone from interest rates that were 1.5% to 2% to 3.5% to 4% today. So a pretty significant backup in interest rates, really across maturities, across the yield curve. And the fundamental problem here is monetary policy. The changes that the Fed is making they impact the economy and inflation with a lag. The Fed doesn't really know how many times it needs to hike rates to slow the economy and slow inflation. It's certainly an imperfect science, and the knock-on problem with that is the odds of recession in the Fed not sticking a soft landing are rising as central banks globally really are trying to tame inflation. And so, kind of a couple other factors I would mention. The Fed tightening is really accentuated by a reduction in fiscal stimulus. So government spending is not growing as rapidly as it was post-COVID. And we're also seeing a very strong dollar. So those are two additional factors that are also act as brakes on economic growth and ultimately inflation.
Yeah, and I just want to jump in and say, markets move ahead of the economy. So Jay, you outlined a lot of points on why the economy has started to move, in a downward manner. And I know you're going to touch on more on how the market is reflecting those economic concerns. But, I think it's important to start planting the seed, if you will, for the rest of you now, that it's important to know that markets front run economic activity. So if you wait for the bottom for the economy to start turning around, you're probably doing it too late. The time you really want to adjust your portfolio for risk is actually when things look most bleak. And talk about looking bleak. I also wanted to kind of touch on the inflation and how it may not necessarily be affecting everyone the same way. So this chart, the very left-hand bar, shows overall total inflation. The other bars break down inflation into their individual components, different areas of spending. So, you can see that by far the biggest driver of inflation was the gasoline prices. For people like us, we're commuting to work, we're traveling, driving around. This is going to impact our daily lives. But those that maybe, they're working from home, they're retired, older individuals who may not be able to drive anymore, they may not be as impacted. So, when I'm talking to my clients, I'm trying to think about what's actually going on in their lives and how much inflation is truly impacting them, because it is a big concern for people who are older. Maybe, they're not working anymore, so they're living off a finite amount of resources.
So let's keep digging in on inflation. And I think really here, the key question is how aggressive and for how long the Fed is going to tighten. So there's a couple of countervailing factors that we're going to look at on this slide. And so on one hand, you have a slowing economy and you have supply constraints easing. You can see the supply constraints in the chart on the top right here. Those are things that you would expect to ultimately push inflation down. So walking through this a little bit further, consumer spending is starting to slow, and that's driven by higher gas prices, higher food prices. We saw that on the slide that Margaret just walked through, rising mortgage rates. We're also starting to see layoffs as demand slows. I had a colleague who's an analyst at the firm just emailed me prior to this, saying that in a lot of the earnings reports, he's starting to see the balance of power shift from employees back to employers as the economy's easing here. We've also seen supply chain bottlenecks start to ease, and there's several examples of many I could give here. Certainly in technology, semiconductors and components, we're hearing that companies are finding those incrementally easier to source. There was pretty significant backups at West Coast ports for a period of time that those have largely been mitigated now. And then the final example would be in the auto market. We're seeing inventories at auto dealers start to rise. And at the same time, we're seeing auto prices start to roll over. Now, on the other hand, as you see at the bottom of the chart here, inflation can be sticky and it can get quite entrenched if consumers come to expect inflation. And what's particularly concerning is the high level of wage growth that we're seeing right now. And it's something that, it's stickier in that it's harder to roll back. It's difficult to tell your employees that you're not going to give them the same wage increase that you did last year, or maybe that you're even going to cut their wages. So we think the Fed's really determined to bring inflation in check before it becomes more entrenched and it's even more difficult for them to rein it back in. So, I think really a key market debate right now is, will the weakening economic data and the market stresses, such as we saw in the United Kingdom recently, cause the Fed to ultimately back off going down the road? And our take is right now the Fed's behind the curve. They're tightening into a weakening economy. And we think there's a growing risk of policy error. And what that means is, in a base case, we're expecting the economy to ultimately tip over into a recession and for inflation to moderate.
Yeah, it seems. Sorry, Jay, continue. My apologies.
Oh, sorry. Good, Jerry.
No, I think you make a good point, though, as you try to transition the discussion from the economy and inflation specifically towards what it means for financial markets. I think that's kind of one of the key questions that many listeners are looking to hear. Yeah,
so I was here for a webinar last summer, so just over a year ago. And really the key takeaway at that point that we were trying to leave clients with was the easy money's been made, and going forward, economic growth is likely to slow. And I think that's generally played out. So this year, we've been in an environment of tightening monetary policy, tightening fiscal policy, high inflation, and slowing economic growth. And that's a pretty toxic cocktail, sort of a perfect storm for stock market performance. And really, despite that market sell-off and the fact that we're officially in a bear market now, when you look at valuations, we're still seeing downside risk there. And beyond the cloudy macro outlook that I just gave, we just haven't seen a capitulation yet where people have thrown in the towel and admitted that there's, come to grips that there's going to be a recession. So we are seeing pockets of opportunity, and that's something I'm going to dive into in more depth, in a few slides down the road here. But overall, the market's not yet washed out. And so we think the next leg down is the market pricing in a recession and earnings expectations coming down dramatically. So what you see on this slide is that in past recessions, there would typically be a 20% to 40% reduction in earnings expectations as you enter a recession. And today, its earnings expectations have been much more resilient. The market still seems to be pricing in peak margins, peak earnings. And I think as companies are reporting, and we're going through earnings season right now, we're starting to see increasing evidence that weakening economic growth is impacting their business. And I think that's ultimately going to get factored in. And I do think we're going to enter a next phase where the market really capitulates and comes to grips that we are indeed entering a recession.
Yeah, absolutely. And we, on the prior slide, showed a particular cut at valuations. And I know it's a question we tend to get, hey, the market's down 20, 25%. Valuations, aren't they looking better? Aren't you interested in buying? And in many cases, yes, we would be. We would want to lean into markets, but it's visuals such as this one right here that suggests to us that it still makes sense to stay patient, to play a little bit more of defense right now and wait for a more realistic outlook to start to get priced into a lot of these underlying businesses. And I know that really kind of leads us into the next question, and mentioned a little bit of kind of playing defense. And so the second section, I should say, that we want to get to is moving beyond just our cautious market and economic outlook, the economic rain, so to speak, towards, okay, what are you doing about it today for portfolios? Well, what is Manning & Napier thinking in terms of, what they should be thinking about going forward, right? So first, I want to send it over to Margaret to kind of, again, I guess I do love quotes, lay out a little bit about what's guiding our thought process there.
Yeah. So as you said, quote, in the business world, the rear view mirror is always clearer than the windshield. Basically, hindsight's 2020. The future, you can't really know what's going to happen. But what you can do is kind of take steps to make sure that no matter what happens, you're best positioned for it. And so that's the, risk management aspect of investing. And the key one I want to focus on here is the asset allocation decision, meaning, what portion of your assets are you putting into safer, quote unquote, investments like higher quality bonds and cash or cash equivalents versus riskier or less liquid investments like stocks or alternative investments. A person's risk tolerance obviously plays a big factor in the asset allocation decision and discussion. But I think so does what phase of your life you're in. So people typically are invested the most aggressively when they're young, they're still working, they have a long investment time horizon. I start talking to my clients about maybe shifting, pulling back a little bit, maybe becoming a little bit less aggressive a few years away from retirement. And then obviously in retirement, people tend to be the least aggressive that they will during their lifetimes. Because at that point, they have what they have to live off of. So, we got to try to help them protect what they have while also maybe, getting them some growth where we can. And another key part of the asset allocations, is making strategic, educated adjustments based on what's going on in the current markets and the economy. It's not a set it and forget it. But obviously the last year has challenged this idea of finding safety in certain asset categories. And Jay, I know you were going to touch on this.
Yeah, certainly the fact that it's been a difficult year, I think is probably one of the recurring themes here. So you can see on the chart here that, whether it's domestic or foreign assets, whether it's stocks or bonds, it's certainly been a year where it's been hard to find a place to hide, to find the traditional safe havens. And so, in previous market declines, what you would usually have is, the stock market would be down, as you see in the pink up or red up at the top here on the left, and the bond market would be up as shown in green. But this year was really highly unique. I think there's 40 plus years of data here. This is the first time where bonds have fallen at the same time stocks have, as you see at the bottom. And they just haven't provided the usual downside protection that you would come to expect. And I think the reason is that, when the economy slows, usually money would get drawn into bonds as a safe haven, but this time investors have demanded higher yields from bonds in order to offset the higher inflation so that they can still get a real yield, and that pushes down bond prices. Going forward, our outlook is that short-term rates are likely to rise further. The Fed's still in hiking mode in order to try to stem inflation and again, prevent it from getting entrenched. Long-term yields, it's a little bit more difficult call, but we ultimately think that long-term yields are capped. And that's one part of it is there's structural factors like demographics and high debt loads, but probably the more immediate and then probably prevailing factor is that eventually we think, again, the Fed is going to cool the economy, and that slowing economy should pull long-term yields down. And so for a long period of time, you may be familiar with the acronym TINA, or there is no alternative. And there's certainly investors, well, yields were very low on fixed income, got pushed into stocks, into equities. Because if you were going to get 1% or so on fixed income, it really just wasn't that attractive. And so that inflated the stock market. But now what we're seeing is higher yields in fixed income market, slowing economy. We think inflation will ultimately be tamed. And with that outlook, bonds start to become more relatively attractive versus stocks than they have been for some time now. So next, what I'd like to talk about is what we've been doing in the portfolio. So we've went through the economy and markets. So portfolios and your portfolios and how we've been positioning them. So I think it's instructive to take a little bit of a step back and walk through the equity allocation that you see here. So coming into 2020 pre-COVID, we thought we were in a somewhat similar phase now, just minus the inflation, where we were late in the economic cycle and we were reducing risk. So 2018, 2019, you can see we were around 50% on equity allocation in the portfolios. That's certainly below a neutral allocation. COVID hit. It certainly wasn't our base case that we were going to get to a recession through a global pandemic, but that's how we got there. There was a pretty sharp market panic, and that was followed by record amounts of stimulus, as mentioned before. And what we saw in the accounts, and you can see it in the green bars here, there was a flurry of activity where we, one, increased the equity exposure in the portfolios, but two, the thing that you don't see here but happened underneath the surface was we were really able to buy a lot of great strategy fits, and I think really upgraded the quality of the portfolio, which benefited coming out of COVID. And as the market recovered, as we moved beyond COVID, we took advantage of rising valuations to trim into that and start reducing equity exposure. And I'd say the story of 2022 really has been one of, our market outlook and our economic outlook have deteriorated, and you can see we've progressively taken the exposure down. And we're now quite considerably below, sort of a benchmark neutral asset allocation at the far right in the chart here. And I realize it's, maybe a somewhat grim story that we've told thus far, but I do think there's light at the end of the tunnel to focus on. So we certainly are in a mode right now of preserving client capital so that, you have kind of the most assets possible coming out of this, into the next bull market. But, certainly we are going to come out the other side of this economic weakness and out of the bear market. We're working diligently to try to identify the conditions that would cause us to walk stock exposures back up. And taking a step back, I talked about how much activity there was during COVID. I've been at the firm for over 20 years now, and that was really the most aggressive action I've seen in the portfolio in terms of the amount of trades that were made in the accounts. And that was really kind of fundamentally driven by how prepared the analysts were in doing the background work to have their stocks priced out, to have buy recommendations ready. And I see the analytical team, really doing all those same things today, putting that hard work in. So I feel quite confident that they're ready to go. We're identifying the conditions, and when it's the time's right to walk the equity exposure back up, we'll be able to do that, and be a well-oiled machine in that regard.
Yeah, and I like this chart because it kind of points out my point on the strategic changes, and equity exposure within an investment objective. So this chart is just long-term growth. And that's the changes within it. So, we do get clients, they see what's happening in the markets, they get nervous. We get calls asking, hey, should I pull back on equities right now? Should I change investment objectives? It's like, it's okay. We're already handling that for you. Just, trust us to do what you hired us to do. And I think this chart really helps to speak to that.
Margaret, I think that's a great point. And Jay, a minute ago, you had made a comment about some of the changes internally to portfolios. I know that that's a bit of feedback we've gotten on these events, is they like to hear from people such as yourself a little bit more color on some of the specific themes and areas that we're seeing opportunity or reducing from. So if you could take a second and actually get into the weeds a little bit more than normal on, some of these areas.
Yeah, absolutely. So let's kind of step back and spend several minutes here going through the current investment themes or sample of the current investment themes, I should say, in some detail. And really, you're going to see a mix here of us playing defense and also us being opportunistic as the market sells off and we're getting some attractive opportunities that are coming to us. So I'll start off first with real estate. And so we've recently increased our positions in medical office buildings and cell tower infrastructure. And what these two, might seem like very dissimilar businesses have in common is there's tremendous stability of income growth during recessions with these businesses. So we think they're quite defensive. Starting with the medical office buildings, these are purpose-built facilities that are on campus or near the hospitals. And the cost of providing care is substantially lower offsite at the medical office buildings. So there's a persistent trend of offloading the care to them. They have long-term leases in place, which again means stability of revenue, and they're able to generate 2 to 3% growth in almost any environment. The cell towers, they're able to generate about 5% annual income growth, and that's really driven by the secular growth in mobile data traffic and 5G deployment. And there's two really kind of fundamentally positive things that 5G does. So one, it requires new equipment on towers versus 4G or fourth generation technology. And that means additional lease amendment revenue for the tower companies. And then secondarily, 5G reduces cell site coverage ranges. So a 5G signal doesn't travel as far as 4G signals do. And that really means you need a denser cell tower network, which is more revenue for the cell tower companies. Moving on to biotech and pharma companies. So there are several that we own here. We think they're strong profile strategy fits. And that's really embodied by these companies have pricing power. There's regulatory and scientific barriers to entry. Drugs nowadays actually cost, on average over $2 billion to develop. Once they're approved, they're patent protected. And again, on the approval side, you need the FDA that's actually a pretty big barrier there. You need regulatory approval in the first place. There's over 10,000 known human diseases, and the majority of those don't have any approved treatments at this point. So there's a tremendous growth opportunity, growth runway for these companies to continue to come up with additional treatments. So we've tried to focus on companies that have differentiated scientific capabilities and that have established revenue generating franchises. And we think that protects the clients, versus there are biotechs out there that you could own, which are pre-revenue, but we don't think that's going to be a great place to be going into a recession. Those companies are not going to have much in the way of fundamental valuation support, if you will. So to give a couple examples here of companies that we own, Vertex is one which has over a decade lead on the R&D side and a virtual monopoly in the treatment of cystic fibrosis. Then BioMarin, that's one of two well-established leaders in rare diseases. And this year, we've seen these companies really benefit on two fronts. One is there have been positive developments in the pipeline. So their drugs are progressing through kind of the clinical stages, the trials towards when they would be approved and hit the market. And the second is these are fundamentally economically resilient businesses. People are going to take their medications regardless of what the economy is doing. It's just a fundamental need. The next area I wanted to talk about was software as a service companies, or SaaS. So these, again, we believe are really dominant profile strategy fits. They have great secular growth tailwinds. They might be 20, 30% growers in any given year. It would include companies like Microsoft, Salesforce, Intuit, ServiceNow, and there are several others that we own. And the great thing about these businesses in a recession is they have a subscription model. The revenues are recurring. They have very low customer churn. The retention rates are generally well into the mid to high 90s. And so that means their revenue growth proves to be extremely durable during a recession. And I mentioned before, a combination of defense and being opportunistic. This is an area where we saw a generalized bubble in growth assets, given the strong demand post-COVID, combined with very low interest rates. Well, that's really started to collapse now and is well into the collapse. And valuation for some of these SaaS companies is halved, if not more. And so we believe we're kind of proverbially picking some babies out of the bathwater here, and that these are really great, multi-year franchises that we're picking up on the cheap right now. And then last, not certainly least, to maybe go back to a defensive theme, we own several consumer packaged goods companies or CPG companies. As I mentioned, very defensive, typically outperform in weak markets. Very strong profiles. These are brands that, surely you'll recognize, like Coke, Nestle, Unilever. And, really in a recession, consumers might cut back on high price discretionary items. You might wait a year or two to, buy a vehicle. You might postpone the travel to Europe, that expensive vacation, but you're going to continue to buy household staples like soda, snacks, soap, that sort of thing that these companies are selling. And then, we've talked a lot today about inflation, and a lot of, pretty much every company out there is facing input cost inflation right now, and you're probably worrying about, you really kind of, your company's preserving your purchasing power going forward. And because these are such strong brands, they're able to raise pricing and preserve that purchasing power for you. So Unilever is really a great example of this. When they just reported third quarter results, they had a nearly 13% price increase, which was the highest on record.
Jay, I appreciate you going through and taking the time to speak to a number of these different themes. I know it's nice to be able to change these up each quarter. I know last quarter we talked about defense contractors and a number of other themes for a specific period of time, but appreciate that. So that obviously leads us into a conversation about performance. And so, Margaret, I'd like to turn it over to you to take a second to speak to how we've done over the past quarter or so. And I would say that for the visual here, as we have been doing for quite a period of time now, continuing to think in terms of full market cycles. So the data has been updated in terms of the current ongoing market cycle dating back to the pandemic. Margaret.
Yep. And so the pandemic drawdown and the current drawdown are now both being reflected in here. And obviously that's creating what's been a difficult nearly 3-year stretch at this point. So what we're looking at in the light green bars are the blended benchmarks for each of our traditional bottom-up led multi-asset class strategies, meaning our strategies that invest in both stocks and bonds. And in the dark green are the results of those strategies. And all these numbers are cumulative, as you said, since January 1st, 2020 through the most recent quarter end. This chart includes conservative growth at the top, where the number is so close to zero that it almost doesn't show up. But yes, that is effectively what the cumulative results have been. While it's not great from an absolute return standpoint, and 0% returns over a near 3-year period certainly are not what we wish to accomplish while trying to help all of you achieve your long-term goals and objectives. Considering the challenges of the environment shown by the benchmarks here, and with the conservative growth one, for example, being down nearly 4% over the same stretch of time, we're still proud of the results of our investment research team and their ability to manage risk and tactically capitalize value over the last couple of years in what's been a really volatile environment. While it's not shown here at all, year-to-date results do remain challenging, both in the broad financial markets represented by the blended benchmarks, as well as our own results. We're certainly not happy with the results that we've delivered year-to-date, but we continue to be focused on the long-term by nature, and we're proud of our ability to deliver value over the longer-term time periods.
Yeah, and just to pick up on that, is noted, it's certainly been a uniquely difficult year, as we've highlighted here a few times. I think with the benefit of perfect hindsight, we would have held more cash, and it's really been a year where you probably the best thing you could have done was just entirely own cash, but that's, we're not market timers. We don't think that that's something that, can be done on a consistent basis. And it's really, additionally difficult to justify owning cash when there's no income generated on it. And we're in a period of high single digit inflation, which is, eroding clients' purchasing power. So it's really not a tenable solution beyond just very, very short term. So we would have hoped fixed income would have proven to be more of a safe haven than it has this year, as we showed prior, for the first time in over 4 decades of data. The fixed income market's been down coincident with the stock market here. So, truly not much in the way of good hiding places this year. That said, we've proactively taken equity exposure down, and I'd say accelerated that this year with our outlook. And going forward, we're identifying the markers that we're coming out of the bear market and looking to be prepared there. And again, as I said prior, I think our analysts are doing a great job being diligent, filling their proverbial shopping carts, if you will, and they have their models ready. Prices are on the desk. They have the buy recs ready to go, and those shopping carts are filled up. And when we get to the point where it's time to raise our exposure to stocks, I'm confident that they'll be ready to, check out and buy those stocks, if you will.
And thanks for the additional color, Jay. I think that hopefully that shopping cart analogy can resonate. And there are times where you want to wait for the best deal possible versus diving in early. And I think that's sort of where the work is happening right now. And Margaret, I know, well said as well earlier, and you made a good point on the challenges within the current market cycle and the results capturing several, both the pandemic and today now at this point before it eventually rolls onto a fresh cycle. But yeah, difficult environment, right? So how can, and I want to turn it over to you to talk a little bit about how stressful environments like what we're going through can be sort of worked through or thought through ahead of time.
Yeah, and so on this next slide, this kind of shows what's known as a Monte Carlo scenario. So my kind of bread and butter is helping our clients here, build out their financial plan. So developing or figuring out their goals. Do they, how much can they afford to save? How much do they expect to spend? Is there any wishes that they have? Like if they can afford it, would they like to do it? And we kind of plug all of this in and do what's called a stress test. So this shows 1,000 different trials, 1,000 different combinations of investment returns over the client's time horizon. And it kind of says, okay, this is how likely the plan or how many times the plan succeeded. In this case, it succeeded 82% of the time, which is a great confidence zone, if you will. So I encourage everyone to review their plan, run a stress test, give yourself peace of mind. And if the results don't look great, then realize that, changes may need to be made.
Along those same lines, can you speak a little bit to what else clients or what we're advising clients could be doing right now as we get towards the end of the year?
Right. Yep. So the previous one, that's an ongoing thing. This one, we're at year end. So you got a couple months to kind of go through your year end checklist, if you will. I encourage everyone to get with their CPA, review their tax situation, maybe take a look at how much income they may have left over for the year. Could you put more into your HSA or your retirement accounts before year end? Review your health savings accounts, for example. Do you have money left in there that you need to spend or you're going to lose before the end of the year? Retirees, make sure to take your required minimum distributions, and those not yet retired, maybe consider a Roth IRA conversion if you're in a low income year, going back to that CPA conversation. Also, think about if you want to make any gifts before the end of the year, whether that's to charities, family, or putting it into like that 529 for a child or grandchild's education. And also take a look at your 401k investments and asset allocations. And again, I'm going back to, has something changed in your life that you should be updating your 401k asset allocations. And lastly, it's always a good idea just to run a free credit check each year. And because it's happening right now, I'm going to plug that open enrollment for healthcare plans are typically running right now for employers, and it's also Medicaid open enrollment. So every couple of years, I suggest people, maybe take a fresh look at their Medicaid coverage or healthcare coverage to see if there's better options, same coverage but cheaper, available out there.
All right. And with that, Margaret, Jay, thank you. That brings us to the close of our prepared remarks. Before we turn to open Q&A, I do want to make sure our listeners know that if you have any questions, either ones that you'd like us to answer here live or more personal ones afterwards, feel free to reach out. We can connect you with one of our financial consultants. We are going to select questions that we see as being most broadly applicable to the full audience here. So some of those might be more reserved for your own unique situation. After all, each person's financial solution and the investment strategies that go into that are unique to each of you. So that is an important consideration to keep in mind. All right. So with that, let's get to live Q&A. Jay, the first one I want to send your way. And this one's actually a pretty brief one to start with, but certainly broadly applicable. We get this question a lot. Jay, should I buy gold?
Yeah, so that's a timely one. We do get that question a lot, and I get that given all the uncertainty in the world, rising inflation, and given the rising concerns about a recession. So it's a great question. So we did a study probably roughly a year back, and we were looking at different asset classes beyond stocks and bonds. And really the reason was if you looked at where valuations were, where yields on fixed income were at that time, it was hard to envision how you were going to get really strong returns from those levels. And that was at the same time we were worried about increasing risk of inflation. And gold was one of the alternative assets that were identified as having some potential. We did take a small position in the gold miners. It's a position we still have today in the accounts. So certainly we see gold as a diversifier and an inflation hedge. That said, I do want to caveat that gold doesn't generate any income, and the valuation is rather subjective. You can't calculate a dividend or earnings yield on gold, and it doesn't always react the way that you might expect vis-a-vis economic conditions. So I think this is a year where people that were really bullish on gold. You look at how inflationary the environment's been, and you might have thought gold would have done better this year than it has. So those are just a few things to keep in mind. We certainly think gold is fine in small doses in the portfolio, again, as a diversifier and an inflation hedge, but not something that we would advocate for clients having a large weighting to.
I got another question here, and I'll take a second on this one. This one is asking about whether they're seeing individual securities or not seeing certain individual securities within their account. It's hard for us to answer that broadly on the webinar, but it was submitted anonymously. So just a reminder, you are certainly welcome to submit questions anonymously, but if we can't get to it broadly on the webinar, it will be difficult for us to reach back out. So certainly feel free to email us as well. That is an avenue. All right, another one here, Jay. Okay, so I'm going to combine two of them because we got this one pre-submitted and I thought it was pretty thoughtful regarding energy positions in the portfolio and some sales we had made. And then we also received a related question regarding exploration and development and our hurdle rate strategy in energy. So I guess, Jay, can you just speak to how we're thinking about the energy hurdle rate and oil specifically right now?
Yeah, absolutely. So as you said, this is another question that we get quite a bit, and it makes sense given how strong oil's been, the news out of OPEC, the Ukraine-Russia war also, pushing oil prices high, very high gas prices right now. So I think our energy analyst did an excellent job identifying that there was a hurdle rate strategy fit here. And what I mean by that is when oil prices cratered during COVID, they went significantly overweight energy at that time, and it was a large positive contributor to performance. Subsequently, we've since sold out of the oil-related stocks as we believe we're approaching a cyclical peak at this point. And as one of the questions pointed out, it's certainly true that supply growth is somewhat more constrained than it may have been in prior cycles. Maybe things like ESG, maybe pressuring some of the spending, so forth. But I would still point out that supply is growing. We're seeing rig counts rising. There is more drilling that's being done, and certainly the economic incentives there for more drilling with where prices are today. But I think the bigger story here really is demand. And so we've hopefully outlined for you today that we expect a recession in our base case. A recession is very negative for energy demand and hence it negative for the energy stocks ultimately.
Yeah, it's supply and demand that makes up the hurdle rate strategy. And too often the conversations or the questions we get are on the supply, not the demand side. Margaret, I want to send this one your way. It's funny that we got a question here. So this is on stress testing. Can we simulate prior sell-offs? Is that something we have the ability to do?
Yes. So I love this tool that we have. We can basically run a combination of whatever you think could go wrong. So a big market drawdown, sustained higher inflation instead of just a couple years worth of high inflation. Does Social Security get cut? Do you lose your pension? We can run a bunch of different kind of like worst case scenarios. A lot of people, are fine with just the Monte Carlo, 1,000 trials of different results. But for those clients that have true concerns about, these more one-off situations, we have the tool to be able to help people look or see what that would look like. And, again, either give them peace of mind or we can help them with some additional planning.
Yeah, I just think that is the coolest thing, that you could be able to sit there and say, okay, let's go through a global financial crisis situation. How will my portfolio react? Will my plan be okay? And that, we put out actually recently shared in the chat just a second ago, a link to our insights on our website. We have a number of insights on our website, one of which discusses the concept of stress testing in additional detail. It's something that we got a lot of feedback on. Then funny to see questions now. I just think it's a very cool tool, and we encourage you all to reach out to us if it's something you'd like us to work on for you. All right, so I got another one here. Jay, okay, so a couple ones. With higher interest rates, how much has your estimate of tech stock valuations changed? But I want to pair that real quick with a pre-submitted one we also got, so sort of related. This one's asking, is it too soon to start nibbling on tech stocks? That always makes me laugh. Nibbling, what is nibbling exactly? Like, are we nibbling on tech stocks? Are we biting tech stocks? Are we gorging? Thanksgiving is coming up. Like, are we doing a whole turkey of tech stocks? Anyway, over to you, Jay.
Yeah, I'll try to weave those together. So hold my feet to the fire and make sure I touch on both of those. So, I'd say in tech, in many of the areas, we saw a massive pull forward of demand post-COVID. And it was really two factors. One was, COVID, many of us were working from home. You might have needed a new computer and all sorts of peripherals, maybe upgraded your phone, need different software. Certainly businesses felt that as well. They needed to work on things like curbside pickup enabled by technology. Businesses needed to rapidly shift to being online and having video conferencing. So that drove a lot of spending. The additional factor was stimulus. The government basically sent consumers money to their bank accounts or checks in the mail, and they used that to buy more phones and other technology. And we're starting to see the hangover effects of that now, frankly. And this, I guess, is where maybe the valuation bit ties in and how interest rate impacts it. Certainly, there was I'd say a valuation bubble in high growth tech stocks. And we saw stocks that were trading at highly irrational valuations, companies trading at, not just 50 times earnings, but they're actually trading at 50 times their sales, which just mathematically doesn't work. And so, as you would expect from us, we avoided those situations. We showed a lot more valuation discipline. So to dial in here just for a second on the specific question of interest rates and their impact on tech stocks, there's no doubt that in the broader market that's causing valuation compression, that interest rates are a factor on tech stocks, and that's their long duration assets which means, with the high growth, you're discounting the cash flows back, many years. That said, when we value these companies, we're very disciplined in the discount rates that we use. So we're using 8, 9, 10% discount rates that really factor in interest rates through cycle. So we're not in our discounted cash flow analysis when interest rates get low, we're not taking the rate of return that we expect down, we're dramatically. So we're only looking for 4 or 5% sort of annualized returns on a tech stocks. We remain disciplined and kept the discount rates very high. So to go back to kind of nibbling, gorging, whatever on tech stocks, the additional kind of thing to keep in mind here in terms of phasing this is tech's certainly higher beta. So it's kind of an amplified move with the market. It tends to go down more than the market. When the market's down, tends to go up more than the market in bull markets. And tech also has a good amount of cyclicality to it. So it's not an area you want to gorge on or load up on during a recession or bear market, which is the current outlook. So I'd certainly note tech is our most significant sector underweight right now. That said, I love that we're getting that question, that clients are thinking opportunistically and they're not being fear driven, and they're forward looking and thinking about how they're going to put capital to work. And that's kind of in line with what we're doing. We're seeing opportunities such as I outlined already with SaaS stocks. And I think as valuations are contracting meaningfully, this really the time you want to be teeing up your best strategy fits. And there's a couple other areas here I would leave you with that we're working on right now. So one would be IT security, and the second would be semiconductor companies. So these are opportunities we think are setting up. So security is a pretty resilient secular growth market, and that's because there's this kind of cat and mouse game between hackers and IT staff. So there's this pretty persistent growth in spending there. It's been an area that we like on a secular basis. We like thematically, and there's a lot of good profile strategy fits. Valuations have just made it difficult for us to own those stocks more than sporadically. And I think with the bear market, we're starting to work on some where we think the valuations are getting to, palatable and even ultimately attractive levels. So that's something that's in the pipeline. The other would be semiconductors, kind of fits into what I was saying earlier about the cyclicality of tech. So hurdle rate is our cyclical strategy, and we think there's a hurdle rate that's starting to set up in memory semiconductors right now. So we're seeing spending on capacity be slashed by half next year. And traditionally, if you think about a hurdle rate, it's capacity gets reined in, and supply and demand get tighter, prices improve, profits improve, and the stocks do well. And we think memory is, that's starting to shape up for us. So bottom line, don't gorge on tech stocks yet. Don't go overweight, but, and that's because of the COVID pull forward that's unwinding and the pending recession. But we do think there's opportunities to kind of start building positions in great companies. So I certainly endorse the idea of some nibbling around the fringes within a balanced diet overall.
Yeah, and a fabulous benefit of being able to go security by security, theme by theme within the portfolios, and to say, hey, at this point in the cycle, it doesn't make sense for us to own this particular area or this theme, but to be more tactical, to be more opportunistic. And there will come a time where we want to own more broad swaths, but we're just not quite there yet. Margaret, the next one I want to send over to you. So this is definitely changing gears a little bit, but we did receive the question in as a part of a holistic wealth management solution, understanding trust in estates and your overall plan there, it's critical. So the question asks, what can I do to ensure my young adult children don't squander their inheritance, mostly 401k assets, if my husband and I unexpectedly meet our demise together? That is specifically how it was worded. So I figured I would give that one word for word. Mark,
I have 2 young children, so I'm very excited to hear this one myself.
I mean, honestly, I could talk about this all day. But I mean, Jerry, you kind of hinted at it. The answer really is a trust. You can put assets into a trust, and you can name trust as beneficiary of 401k or IRA. We also have something here called IRA trust. So you can kind of do it while you're still alive, but realizing you're still the owner of it until your actual death. So the key thing here, though, is choosing the trustee that you want to be in charge of the trust assets, because if you're worried about your kids spending the money, then don't name your kids as the trustee, so you could name a close family member, a friend, an attorney. We can act as trustee. There's a lot of different solutions. And, if people listening are interested in learning more about the wide berth of what trusts are and what they can do, then we actually do have a webinar next month dedicated to this topic. So I would encourage you guys to tune into that if you're interested in learning more.
Yeah, great plug, Margaret. On December 6th, we have a trust specific event. You can access it on our website, manningnapier.com/events. Feel free to register. It's certainly open to all. So we're getting close to the top of the hour here. There are a number of additional questions, although I think it would make sense for us to hold off on these and follow up individually. We will be sure to follow up with each of these and others after today's event. If you have any questions, feel free to submit them to info@manningnapier.com. We also put a survey into the chat as well. We encourage you all to click through that survey. Let us know what worked, what didn't. The feedback we get from that drives how these events unfold each quarter. So any feedback, we certainly encourage you all to provide it. Lastly, useful reminder as well, the recording of this webinar will be available shortly after the event here. So with that, Margaret and Jay, thank you both for being here today.
Yeah,
Thanks,
I hope
everyone.
hope the info was helpful to everyone. Thanks for having us.
And to our listeners, thank you all for attending today's webinar.